Money and banking. That's sweet. Today's overarching question is, it's a good idea to put part of your monthly income in a savings account. Agree or disagree? Okay, so take a few minutes, write at least 2 points for each of the questions there. So you start by recording the slide number, copy the statement, and say whether you agree or disagree, and write 2 points for incentives, for sacrifices, and for alternatives. Whatever comes to your mind, by the end of the lesson, you're going to be much deeper. Once I asked the students, what is money? And someone said, money is everything. Well, no, you have to think about the functions of money, and the most important and obvious function of money is a medium of exchange, right? That would be our solution to barter, which is a direct exchange of goods and services without any intermediary. So the intermediary would be money. So for instance, in the primitive societies, if you were a farmer and you had wheat, let's say you wanted some apples, what you had to do is you had to offer your wheat in exchange for apples. But the problem is, what if the other side doesn't want your apples, right? Or how would you know the equivalent of how much wheat is equal to the apples? And you need to have equivalence for everything that people buy, right? So that would be a mess. That would require the double coincidence of one. So everybody should want what the other side has to offer, right? So look at this guy. He's gone to the doctor and he wants to pay with a hog or a hen. So the solution to that is money. If you have bread and you want meat, well, what you do is you convert your bread to money, and then you use that to buy meat, and the meat producer can also buy whatever they want. Okay, so pause here, record this slide number, 1 sentence summary, and some notes. Money is also a unit of account, which is a numerical unit for expressing the value of goods and services. So here's the thing, think of other units that you know. Let's say a unit of weight could be pounds or kilograms, a unit of length could be inches or meters. Well, we also have a unit for expressing the values of things, right? So for instance, GDP is measured in dollars, wages are measured in dollars, and prices in general are measured in dollars. So we use money in the form of dollars to express the value, the market value of things. Another function of money is that it's a store of value or a store of wealth, which is to say you can put it away for future use. That's where you store your purchasing power in the form of money. Well, isn't that a cute piggy? So the idea here, remember this idea of purchasing power? So when you buy things and how much you can buy things. Now here's a couple of questions for you. If you have a lot of money and you store it for future, but then there's inflation, is that a good idea? Remember, when there's inflation, your money loses value. So maybe you don't want to do that in the form of money. So if there is inflation, then money wouldn't be a good store of wealth. So the last function wouldn't work very well, right? Another example is this. Would it be a good idea to buy a car as a store of value? Does that keep the same value? Well, no, because the minute you drive it out, it's going to lose its value. As opposed to land. Land is actually a very good store of value. All right, so pause here, record the slide number, 1 sentence summary, and some notes. Money comes in a few forms. One of them is the currency that you know. Yeah, by the way, you see here the penny, which they terminated about 10 years ago. It was such a good thing. I miss the penny so much. But anyway, there are all these different denominations of money. But it also includes demand deposits, which are also known as checking accounts. So these can be withdrawn without prior notice, and they don't earn interest, and they're transferable by checks. Okay, and it also includes notice deposits or savings accounts. So these sometimes require advance notice before withdrawal, so they are less available slightly, and they earn a little interest, right? So the little rule here is that the more you lock in your money, the more interest you earn. Okay, so one thing that I want to emphasize here is that money is not just cash, it also includes what the deposits in the banks. Okay, so your debit cards, for instance, they're a good form of money. Debit card is really like the Opus card. It's just a different form of representing the same thing. Okay, so pause here and take notes. Wow, that was cool. All right, this is a very important concept, liquidity. What comes to your mind when you hear this word liquidity? Maybe water or river, something that has a flow, right? So liquidity is how easy it is to convert something into cash. And the most liquid asset is money because it's already there. Okay, so basically think of a house, for instance. You cannot use your house to buy things, Or think of stocks and bonds. If you have some stocks, you cannot go to the store and pay with stocks. You have to first convert your house or your stocks into money, then you can buy it, right? So those other assets are less liquid. And let's remind ourselves that money is not the same as cash because it also includes demand deposits and notice deposits, or checking and saving accounts. The simple rule is that the higher the liquidity, the less interest, right? So if you think of cash, you don't earn interest on your cash. If you want to earn interest, you have to put it in a bank, then you earn interest, but then it's not liquid anymore. It's less available to you, right? So there is this trade-off between liquidity and interest, and the trade-off is called opportunity cost, right? So opportunity cost of interest is liquidity, and this is super important. If you want to earn interest, it won't be available. And if you want the money to be available, then you won't earn interest. Okay, so pause here, one sentence summary and some notes. This is a very common misconception among students which I want to clarify. What is money? Money is basically a form of wealth as opposed to bonds. Okay, so we have these two forms of wealth. Money is basically what you use for transactions, and bonds are whatever would earn interest. Okay, so it's common among students to think of money as being the same as good. First of all, thinking in terms of good and bad, that's not how economists think. If you want to be an economist, you have to kind of get rid of that mentality because we're always talking about opportunity cost. So get rid of that. Money is not the same as good. Money is the same as liquidity. Okay, money is the opposite of interest. Okay, so you have to think about this dichotomy between liquidity and interest. Liquidity means what you can spend. Interest means something that you have in the future. Okay, and money is the opposite of bonds. Now, what are these bonds? These bonds are really IOU papers issued by the government or the corporations. This is how they borrow. Okay, these are their loans. Okay, and they promise your money back in the future with interest, so it is the same as savings. It's a form of saving. All right, so in economics, whenever we use bonds, it basically means something that is not liquid but pays interest. So it's a very broad category which includes anything that pays you interest. Okay, so more money isn't the same as more wealth. More money is the same as more of one form of wealth and less of another form. Okay, so I would emphasize this word form here and this word form. So let's say your wealth is fixed at $1,000. If you have $1,000 of wealth, you have to decide how much of it you want to have in the form of money and how much of it you want to have in the form of bonds. The more of it in the form of money, the less of it in the form of bonds. So it's all about opportunity cost. All right, so that's super important. Pause here, write a one sentence summary and some notes on both money and bonds. Now you might be like, hang on, how about credit cards? Where do they lie? Well, credit card is actually interesting. It kind of sounds like plastic money, right? But the thing is, credit card is not money. And let me explain to you why it's not money. Let's say you go to a store and take an item that's $20, and you want to come out of the store, you have to pay $20. So you take out your credit card and you give it to the storekeeper, and you come out and you're done, right? The transaction is done. But the question is, are you off the hook? Is it done? Is it really a done deal? What happens is that at the end of the month, you still have to pay that $20. So the credit card is not really a form of money. It's not used for transactions. What it does is only postpones the payment to later. You still have to pay your bill with money, which is not just cash. It could be from your checking account, right? So that's not money because credit card creates debt as opposed to money, which discharges debt. All right. Now another interesting question is, why do merchants accept credit cards given that they have to pay a fee? No, they have to pay fees for having the machine and all that stuff, right? So this is very interesting because accepting credit cards will increase their sales, which means it's going to increase their profit. So really, they also think about alternatives and sacrifices. They do sacrifice something, which is the fee, because they make a better or higher benefit. And that's exactly why some stores don't accept credit cards, because their sales won't work out in a beneficial manner for them, right? So they also weigh the cost versus benefit. So credit card is really a form of borrowing. Another concept here is gold standard. So that is when the money or the currency is backed by gold. So basically you could convert any bill to an amount of gold at the central bank. Okay, but we don't have that anymore. Basically our money right now is not backed up by anything, but it is accepted because of the trust of the currency that we have. Okay, so there's trust among the people, and the reputation is enough to guarantee that. All right, pause here, take notes in your own words. Moving on to a new topic of the banking system. Our banking system basically consists of two main branches. One of them is the central bank, and the other one is the commercial or chartered banks. The central bank is the public sector, and the commercial banks are the private sector. In economics, when we say public and private, we mean something specific. Public means governmental, and private means firms and households. Okay, so we're going to look at these in sequence, but first take some notes. Our central bank is called the Bank of Canada, and it is in Ottawa. They don't have branches like commercial banks where you can go and open an account. So they have very specific functions, such as controlling the money supply and the monetary policy. So we're going to look at that, but the central bank is the organization which prints money. It's a banker to commercial banks, and it's a lender of last resort. So what the lender of last resort means is that if, for instance, there is a panic, if everyone wants to take their money out and the commercial banks don't have the money to give them, then the central bank is going to cover for them. So they're going to give them money as a loan. It's officially owned by the government, so it's a public institution, but operationally, practically, it's independent. All right, and I want to emphasize this is super important that the central bank remains independent of the government. Okay, so why? Think of this lifespan of the government. It's about 4 or 5 years. That's their time horizon. That's how far they see. So you have to think about the incentives of the government. In about 4 years, there is new elections, and they would like to win the votes, right? So they want to be popular. Now, a very quick but not smart way of being popular for a short period of time is printing money, right? So you can print the money to stimulate the economy and win the votes. But the problem is that this is just a quick fix, not a real fix. In the long run, what happens is that if you flood the economy with money, there's going to be a surplus of money. And you know that whenever there is a surplus of anything, its value goes down. So money is going to lose value, and that's called inflation. So what happens is that this is going to create inflation in the long run because of the short-sightedness of the government. All right, so we want to have the central bank unaffected by the government so that they are not influenced by or persuaded by the impulsive incentives of the government. Any country that has a high inflation rate, it's because the central bank is influenced by the government. All right, so that's an important lesson to learn there. You might also see in the news this idea of Federal Reserve, and sometimes in short form they call it the Fed. It simply refers to the Central Bank of the United States. All right, so pause here, write a one-sentence summary and some notes. On the private sector, we have the commercial or chartered banks, and these are the banks that you know. So those are the banks where you have an account, such as checking and savings account. So that's one of their main functions. They also make investments such as mutual funds. So mutual fund is when different people put in their money for investment. So it's pooled, and then a bank advisor purchases a portfolio of different stocks and bonds. It's a fairly safe form of investing. They give you loans like student loans. A very major loan is a home loan, which is called a mortgage. So if you hear the word mortgage or read the word mortgage, it's simply a form of loan. They also have insurance, like home insurance and other forms of insurance. They do safekeeping of valuables, so you have safe boxes, you might have used that. They offer foreign exchange, so you can buy foreign currency at the banks. And you can transfer funds. So for instance, if you want to send a fund to other countries or other cities, you can do that. So have you heard of wiring money? So wiring money is when you put your money in the wire, right? Like that. They have bill payments, so if you want to pay your cell phone or whatever, you can use the bank. And they have their own credit cards. Okay, so those are some main functions of the commercial banks. The ATM is also interesting. It's really just an extension of how the banking system works. It's a replacement of the clerks, but it's really just the same principle. So pause here and take down some notes in your own words. Here's a question for you. How do you think the banks make money? What is their main source of income? Now, some of you might be like, oh, well, they charge me fees every month, so the fees that they charge is their income. Well, yes and no, that is their income, but that's not their main source of income. The main source of income for a bank is the interest they charge on loans. So when they give out loans, they charge interest on that. That's their main source of income. Okay, so there is this formula where the interest spread is the bank's income, and it's the difference between the interest that they charge on loans and the interest they pay on the deposit. So for instance, if you put your money in the bank, you get interest, which means the bank is paying you. But that interest is much lower than the interest that they would charge on loans, right? So the difference between those two would be the bank's income, okay? And then the dilemma of the bank is how much cash reserves to keep, right? So the bank has some incentives involved here. There is some incentive to lend out their deposit because they would earn interest. So they would ideally like to lend out a lot because that's how they make money. But they don't want to lend out everything, because if they lend out everything and somebody goes there to withdraw their deposits, then they're in a mess, right? So they need to, so if you go to the ATM and it says out of order, it's not really out of order, it's just out of $20 bills, right? And if this happens a lot, it can be bad for the reputation of the bank, or it can create a panic. So again, we have opportunity cost. The bank has to decide between how much to lend out and how much to keep. All right, and that gives rise to the fractional reserve system that we have, which is when the banks keep only a certain amount of their deposits, not everything. Why? Because of the incentive to make interest. So pause here and take down some notes. Wow, that was nice. All right, so we have this thing called the deposit creation mechanism, which says that whenever there is any deposit in a bank, it's going to be multiplied in the banking system. So there is a domino effect, there is a ripple effect. All right, the reserve ratio, this is some terminology here. This is the cash reserves relative to the total deposits, and the desired reserves would be how much reserves the bank would want to hold, right? So that is the amount that they need for daily needs, for the daily transactions. Okay. Anything in excess of that is called excess reserve. So that is lent out to make profit or to make interest. All right, so this is just some terminology. And to see how it works, we're going to look at an example. Imagine that there is an initial deposit of $100 in a bank, and the desired reserve ratio is 10%. Okay, so what it means is that the bank would keep 10% of that and lend out the rest. So what you have to do is, I don't think you need to punch it in because the numbers are super easy. So fill in the blanks when you take your notes before we proceed. Let's put the example that we have in a table to see how it works. So the initial deposit is $100. So we're going to put that in a deposit column, right? The bank would keep 10% of that. What is 10% of $100? $10, right? And that is called desired reserves. That's how much they keep. They lend out the rest. What is the rest? 100 minus 10 would be 90, right? So that would be excess reserves. So far, so it's fairly easy, right? Now here's what you have to think. What happens? What's basically happening is that the bank is willing to lend out $90, right? So somebody comes to the bank and says, hey, I want a loan. Do you have a loan for me? And the bank is like, yeah, I have $90 for you. So if they're qualified, they get a $90 loan. What happens to the $90? The $90 would leave the bank, and what would the person do with it? Well, they are taking a loan probably because they need it. They need to spend it on something. So they go and spend it on something. When they spend the money, when they spend the $90 on something, it becomes the income of someone else. It becomes the income of the seller. And eventually, that would be deposited again in the bank account of the seller. Right? So somewhere down the road, the $90 is going to be spent and reinvested in the bank. Okay, so that's where you get a second deposit. But the same logic applies again. The bank would keep 10% of that, right? What is 10% of $99, right? And what is the remainder? The remainder would be 81, and that's available for lending out. Okay. What happens to the 81? Well, somebody would borrow that and they would spend it, and at some point it becomes the income of someone else. Remember the circular flow, right? So it becomes another deposit. All right, so what I want you to do is to have exactly the same table that you see, 6 by 3, and fill the rest. So you should be able to find the numbers. If the numbers become nasty, you can punch them in a calculator, that's fine. But it shouldn't be too hard to get the table done. Now what you see is that the deposit would go down, all of the values, all of the columns would actually go down, and eventually it's going to reach 0. And the withdrawal would do the same thing. If somebody withdraws $100, it's going to call back the loans, right? So it's going to contract the amount of total deposits. A deposit will expand, a withdrawal will contract, okay? The moral is that a deposit triggers a chain of further deposits. That's the ripple effect. So pause here and do a table for yourself and make sure your table is complete with all the numbers. Now you might be like, hang on, what's going to happen to all the deposits? Can we find the total amount of deposits in the economy? And the answer is yes. Actually, there's a formula which is very simple where we can calculate the total deposits, and that's just initial deposits over the reserve ratio. So I would box that or highlight that because you're going to need it when you do questions. And the only trick here is that remember that the reserve ratio should be in decimals, so you should convert the percentage into decimals. Another formula that you need is called the bank multiplier, which is 1 over the reserve ratio, again in decimals. So let's do an example. Following the numbers that we had, let's find the total deposits and the money and the bank multiplier for the given example above. So remember the initial deposit was $100 and the reserve ratio is 10%, and you convert that, it becomes 0.1. So you just plug in the numbers, you have to find it yourself and see what you get. This is not complicated, okay? So this is not rocket science. One checkpoint is that the bank multiplier would always be greater than 1. So that if you get a multiplier that is less than 1, then you probably forgot to convert the reserve ratio to decimals. Okay. There are two other names for the bank multiplier. It's also called the money multiplier and the deposit expansion multiplier. So when you do questions, if you see those words, they refer to the same thing. So pause here, take down notes, and make sure you have the formula. Money demand is the total amount of money or liquidity that people want to hold. It's how much of their wealth they want to hold in the form of money. All right. So it's not that money demand is infinite because people want to have infinite amount of money, because remember, money is only a form of wealth. It's not the same as wealth. Money is a form of wealth which is liquid, so that's a good thing, but it doesn't give interest, and that's the catch. As opposed to what we call bonds, which are exactly the opposite. They are not liquid, but they do earn interest. So that would be the positive of that, okay? So the money demand is also called liquidity preference, which is a demand for liquidity. And this is about the preference for liquidity instead of interest. So we have an opportunity cost. You can have only one of them. Ideally, we would like to have our wealth both available and give us interest. So we like to have liquidity and interest, but we can have only one of them. If you would choose one, you have to sacrifice the other. Now you might be like, hang on, if people don't earn interest on money, why should they hold money at all? Why not just bonds? And the answer should be fairly simple. It's because of transactions. So we have day-to-day needs, we have day-to-day purchases. For that reason, we need to have some money available in the form of liquidity. There are also other forms, other reasons for holding money, but the main thing is transactions. So pause here, record the slide number, write a one-sentence summary of this slide in your own words, and some notes before we proceed. Just to recap, we have money versus bonds. Money is liquid, bond gives interest, okay? I emphasize this, I repeat it because it's super important. Now, given this, you should be able to fill in the blanks here. If the interest rate is high, which one of the two is more attractive? And if the interest rate is low, which one is more attractive? So you should write that down when you write down your notes. The interest rate is the opportunity cost of holding your money. When you choose to hold money, you are letting go of interest. That is what you sacrifice, okay? So that's effectively the price of money, all right? Now, this is where we can have a money market. And if you remember, in any market, we had price versus quantity. So the price of money and the quantity of money. But the price of money doesn't really make sense. It's not that you pay money to have money. That's not what you do. What you do when you hold money is you are sacrificing something, and that is going to be the price of money. So the interest rate, R, would be the equivalent of the price of money. The higher is the interest rate, the more attractive would be the bonds and the less attractive would be money, right? So that would give you a curve like this, which looks the same as any other demand curve, but the logic has to do with interest rate versus liquidity. Okay, so I really want you to get that. Now, given this graph, you should be able, by the way, it's also called liquidity preference. So if you see in some books that it says LP is the same as money demand, given this, you should be able to tell what is the slope and what is the correlation. So does it slope up or down, and is the correlation positive or negative? Okay, so write those down and you take your notes. Also have a one-sentence summary for this slide, which is quite important, and do a little graph for yourself and do a neat job. If you have a ruler, please use a ruler. So pause here and do a good job with your notes. Let's have some fun. We talked about money versus bond, where money is the same as liquidity and bond is a type of loan. The advantage of bond is that it gives interest. The banking system has a central bank monitoring the commercial banks, which have to decide between liquidity and interest. They operate based on the fractional reserve system, and that's how they give loans. The system creates the multiplier effect, which is how the money supply is expanded. The two concepts I would emphasize here would be liquidity and interest. So take a few minutes to draw your own concept map. It should be your own, so be creative with it. Look at some concepts that we had in the lesson that's not covered here, and try to make your own. If you want to use the one that I have as a template, make at least 3 major changes to it so that it belongs to you. So thank you for your patience. Let's come back to our question of the day. Take a few minutes to write again your answer to the 3 questions based on what you learned today. We talked about savings actually. So what do you think is the incentives, the sacrifice, and the alternatives involved when there is saving? Write at least 2 items in your notes, and after that I'm going to show you some sample answers. So for instance, you could say that the incentives is to earn interest and to keep the money safe. The sacrifice is liquidity. It's not available to spend. So this liquidity, actually, we're going to see it later, but the idea is availability. And you must pay tax on the interest. So that's kind of smart if you can think at that level. The alternatives are a checking account, which is more liquid, and other forms of financial investment, which give you more interest, right? So those are some possibilities. All right, have a great day.